Hello, everybody. We're back for a little Truth or Skepticism. Mr. Radigan, how are you?
Very well, very well. Nice to be seeing you. Pleasant greetings to you.
Just seemed like a week ago you were hanging out in Chicago, enjoying the beautiful Chicago sunshine, and now you are gone again, world traveler, you.
And well, back to Milan, which they say is the Chicago of Italy, by the way. So they're like sister cities in a sense.
Oh, I don't know about that. No.
I mean, what? How could? What do you mean? No.
No.
Why not? Why no? You need at least one reason why no.
Oh, I don't think Milan. Well, I've only been there once, but I don't. No, it's not Chicago. If I had to line Milan up with any city in the U.S., I would say Milan's much more New Yorkish than Chicago-ish.
Really?
Yeah.
What's the distinction between being New Yorkish and Chicago-ish, if I might ask?
Well, if I remember, like Milan's very, it's more fashion. It's,
You're saying Chicago's not fashionable?
No, I'm not saying it's not fashionable, but it's the Midwest. It's not like a fashion capital,
Sure.
Yeah, and Milan's like, I mean, Chicago's very, also is New York, I guess, skyscraper-ish, but it's, I don't know, I'd say Milan's more.
I would say Milan is very productive. Very enterprise driven. It's the only enterprise and productive city in.
Yeah, I would say it's more like New York, but whatever. That's just my 2 cents.
Either way.
Yeah.
The one thing I will tell you is you can't fly from here to there.
Which is crazy because I did make that flight before Alitalia or Air Italia, whatever it is, before they went bankrupt.
The COVID bankruptcy of Alitalia, tragic for all of us.
Well, if there was ever a global airline that should have been out of business, it's that one.
Well, what about Lufthansa? That's who got me to Frankfurt. I wouldn't mind seeing them go.
They're one of the worst airlines too. They're not good. But Alitalia was worse.
Mm-hmm.
Yeah.
It's interesting. While I was on that Lufthansa flight after seeing you in Chicago, I was reading through the papers, and I noticed a comment from J.P. Morgan in the papers. I didn't see who at J.P. Morgan, so that's really, it wasn't actually from J.P. Morgan. I think he died actually a while back. But a strategist or some spokesperson for the institution named after the once great statesman of finance. And the headline was very simple, really. It was not complex. It said, 0 days to expiration options will turn a 5% down day in the stock market.
Yeah.
Into a 25% down day.
Yeah, we all read. We all read that.
Okay.
Yeah, is this one of the stupidest comments that anybody's ever made? I mean, like
really?
People like that. The fact that they have jobs and they're analysts. Like, what cracks me up is that some idiotic media network like Wall Street Journal or something picked that up.
I think it wasn't the Wall Street Journal.
Yeah,
I was like, oh, the Wall Street Journal thinks that these ZeroDTE.
Yeah, I know. But do you know if anybody else made that quote? Like, people would laugh him off as just being a total idiot and a lunatic. But since it was somebody at J.P. Morgan, they could actually print it in the Wall Street Journal. That's what I hate about financial media. Not only is that comment ridiculous, but you have to remember a couple things about ZeroDTE. First of all, most of the activity is, just as we said, ZeroDTE, which means it expires on the close, which means there's no overnight risk at all. And the second thing is that I guarantee that person has never made a trade in ZeroDTE options. They have no idea what they're talking about. And most customers are actually, buyers of ZeroDTE options, not sellers, because with the way the pattern day trading rules work and the way the requirements are, do you know how to trade one ZeroDTE option from the short side in the SPX, the S&P 100, S&P 500? Requires about $80,000, and the risk on that trade's about somewhere between, let's call it $1,000 and $3,000, and you have to put up $80,000 to do it from the short side, so nobody does it. People that write those articles are just plain stupid.
No, let's not go after the journalist here. I think that we go after the analyst.
I'm going after the journalist only because the journalist would never
indulge the analyst and gave him the headline.
Yeah, I mean, would the only reason the journalist wrote that article is because the analyst was from J.P. Morgan. If the analyst was from Tasty Trade, they would have laughed. Now, the other thing to note, besides the fact that the options carry no overnight risk, the other thing that's really important to note is that since ZeroDTE options came out, volatility's dropped like 20%. And
do you think there's a correlation?
There's an absolute correlation, because a lot of the risk capital that was going into much more dangerous plays, like in all these different equities that were, 30, 40 days out, is now going into overnight options, and which into single day options.
Which you're saying, by definition
carry no overnight risk. We've basically taken 50% of the overnight risk out of the markets, not added to it. So it's completely the opposite. In my opinion, the real story here is that ZeroDTE options have eliminated probably 30 to 35% of the risk in the stock market, in the derivatives marketplace, that used to be there with the longer dated options. They got it completely backwards, is my point.
I understand your point. And you're saying that they're taking advantage of a once great banker's reputation, even though he's long dead, being Mr. Morgan himself, and trading on his reputation to get themselves an audience in the Wall Street Journal.
Well,
to say dumb things.
The way that Morgan Stanley.
This is J.P. Morgan.
I'm sorry.
Morgan Stanley out of this.
I think J.P. Morgan and Morgan Stanley may be the same people, but whatever.
It was the same guy way back when, but they're different people now.
Okay. Well, the way J.P. Morgan works is, the way their PR department works is that anybody that can get a quote in the Wall Street Journal, they get a raise.
That's how you get paid.
That's how you get paid. So it's based on number of sentences, number of words that are quoted from you in the Wall Street Journal. So today, Joe Blow from our New York office had 17 words quoted in the Wall Street Journal. So that's good for us. It doesn't matter what he says.
Three shekels for him.
Yeah, I told you my favorite story once from a reporter at the Journal I had worked with before, and she was quoting me. She said, I go, is this going to be in tomorrow? And she kind of laughed and goes, Tom, I'll print this. I'll print this tomorrow unless somebody from Goldman Sachs calls me first. So
you think there's no risk amplification from ZeroDTE?
I mean, it's crazy to say no, because under the perfect storm, lots of different things can happen. But the idea that people are like, oh my God, 5% to 20, I mean, they expire at the end of the day. Okay, there's nothing there. And you're taking all the long-term risk out of the market and putting it into something intraday. It's not.
Right, but maybe because you're bringing all that risk into the intraday, you're overloading the daily risk as opposed to spreading it over 40 days.
Okay, you know what? I mean, we can speculate forever, and the first day we have a 4% down move in the market, so everybody's going to go, oh my God, ZeroDTE options. But what hasn't happened is, since they launched these ZeroDTE options, since they launched them till today, all that's happened is volatility's crashed. So explain that to me. And I would like to say one other thing. DTE is a tasty phrase.
Really? So that's a phrase coined by you or by Tony?
By me and Bat.
Okay.
It's actually me, but I have to give Bat partial credit. It's per my contract. He has to get, he was on the show live.
He rides in the car.
We used DTE for the first time on this network, and was about 10 years ago, and it's become industry standard now.
All right, enough.
Yes.
Rates are going crazy here. What are we doing? What are we doing with the spread, the 2s, the 10s? It looks like
we're getting killed. Okay, we're getting killed. We're getting hanging up. We're hanging by our fingernails right here. It
hurts. It hurts. What's happening, sir?
It hurts. It hurts. I'm getting hurt the last couple of days. I lost a. What's the famous? What's the Italian car everybody drives?
A Ferrari.
No, I didn't lose a Ferrari.
A Lamborghini.
No, I didn't lose a Lamborghini. A Fiat?
Sure.
A used Fiat.
a Panda 500.
No. It's probably
with the roll down window.
Oh, I used to. My dream car when I was in college was a Fiat Spider. Mm-hmm. I saw one on the road once. I'm like, oh my God, that's the most beautiful car I've ever seen. I wanted the Fiat Spider convertible. I don't know if they still make it. I don't know if I've seen it in.
Or they don't.
But whatever.
But they do make the old Pandas. I have thought of buying myself. Well, you can buy one of those old Pandas.
I don't know what a Panda is.
It's just like a tiny little box of it. It's like a Yugo, but even smaller. It's like like Mr. Bean.
Yeah. No, I didn't. No, I lost a little. I lost probably Like a
couple of those.
No, just a fiat. Yeah, whatever. A couple pandas. Not nearly even in the top 100
But
of my.
regardless of your personal financial issues, what's going on here, bud?
We're at a multi-decade. Where the yield curve has flattened to multi-decade inversion. It's still not back to the level it was when I first entered this business in the late 80s to the. Late 70s to the early 80s, like that period from like 78, 79 to 81, where it went to 200 basis points inverted. But that's when rates were 20% or 22% in short term, 20% long term. That was like a whole different world. 21% short term in the T-bills, and then 19% in the 30-year. That was like 1980, 81, right in there. But we've never seen rates at these levels, like 5 and 4. That's really where we are right now. The 2-year is at 5 and the 10 and 30 years at 4, or below. So this is the biggest inversion we've seen, I think, since around 2000, but whatever, really going back, either 20 or 40 years, doesn't matter. So there is a price extreme there, and it's super interesting. And a bunch of us, everybody has it on
What's the best trade if you're contrarian to that? If you think, what do you think is the most interesting trade the other way?
It doesn't. You just have to be. You have to be short 2-year. You have to basically trade the most liquid products. You have to be short the 2-year, which is the ZT, and long anything you want against it. It doesn't matter what you're long or what the ratio is. I'm sorry. You have to be. I'm sorry. I take it back. You have to be long the ZTs and short anything else against it. That's how you play the inversion. That's the steepener play. And it doesn't matter what you sell, against it. You're basically, at this point, you're selling the 2-year yields and you're buying anything longer term. So you're betting that it will steepen and go back to being normal. That's all you're betting. And it always does. It's just a question of when. So does it happen? Does it happen 3 days from now, 3 months from now, 3 weeks from now, 3 years from now? Like, nobody knows. They've been waiting in China. They've been waiting in Japan for 2 decades, maybe 3 decades. But we are not Japan, and this will never be Japan. And so, for me, is it 3 days, 3 weeks, 3 months, or 3 years? And I've ruled out 3 years, and I've ruled out 3 days. So it's either 3 weeks or 3 months. Pick your poison.
How did you rule out 3 years, if I might ask?
Because I might not be around in 3 years. So I'm a realist. So I have to.
I actually think if we were to go to the actuaries and buy price life insurance on you at this point, I know you just had a birthday, but I think the odds that you're around in 3 years are actually extraordinarily high.
Well, the puts on me have been expiring worthless every year. Like, if you've been selling puts, like back when we used to trade in the pits, we would buy puts on each other. Like, we legit trade
on lifespan puts.
Yeah, I had a guy next to me when we were in our 20s, and we used to call him Big Bob because he was about 300 pounds and about 6'9", 6'10", 6'11", and I figured he was lucky if he made it to 35 or 40. So the 40 puts on him traded for about 5 years, back and forth. Everybody was trading 40 puts on him.
Based on his lunch that day.
Oh, he's still fine today, and he's 60. So yeah, Big Bob has outlived his coverage by 20 years on his 40. The 40 puts expired worthless. The 50 puts, the 60 puts. Oh, he's doing great.
Okay, back to the bond market.
Yeah.
How robust is your opinion? How aggressive are you willing to be long the 2-year, shall we say, as a metric of your sentiment?
I have my personal position limit, which is less than my personal position limit was. It's a fraction of what it was 10 years ago. It's less than it was 5 years ago, but I've been trying to get your
maximum exposure under your current
Yes, I've been trying to get smaller over the years because I've been trying to be a little more disciplined. So I'm at my current. I maxed out yesterday, and it's a little bit against me today as well. But I feel like I'm not adding to it anymore.
And we talk all the time about efficient market. News doesn't, the data this, if you knew what the Fed was going to do that, blah, blah, blah.
Sure.
But at the same time, you got the Fed chairman talking, he's jammering. You got a CPI number, a headline coming, I think it's next Tuesday or something. There's a bunch of data coming down the line. How relevant is the day-to-day in your opinion, or do you think the pricing is much more a function of, extremity and mean reversion more than it is?
Oh, I mean, so first of all, pairs. This is essentially a pair, right? It's not. These are two different, very distinct underlyings, and in the world of pairs, although there's no such thing as mean reversion with respect to price necessarily, there's no mathematical model that supports mean reversion with respect to price.
Sure.
There is enough statistical significance in the research that we've done. And Jacob Perlman, who's our math geek, did a couple of amazing pieces on mean reversion, the significance of mean reversion in pairs pricing. And we can make a pretty strong argument that although nobody knows what the duration will be, mean reversion in pairs pricing is pretty evident. And it is supported statistically because you're not betting on a traditional price, black and white. You're betting on a gray spread. It's a basis spread bet.
Mm-hmm. So in other words, if it's simply being long the 2 year is God bless you, but being long the 2 year and short anything else has some mathematical.
Exactly. It just doesn't have a time frame, but based on the U.S. markets are very different than markets elsewhere around the world. And our markets are very, very, there's so much money chasing U.S. markets that our markets are extremely cyclical. And I just, feel like, right now there's certain spreads, that being one of them, that are at price extreme. And, there's not that many other price extremes right now. We're not in a market where there's really good price extremes. And so I think this is interesting. Yeah, for sure.
All right, I got nothing more here.
No, we can change topics. Let's go. We got a good topic.
Amazon saying your friend Josh. Your friend Josh over at tastylive.
I met him once. Yeah.
He seems to think that this whole there's a situation where Amazon came out and said, if you're an Amazon employee and you have a stock award of some kind of Amazon stock, that you have the ability to use that stock as collateral for borrowing, cash for today, for a mortgage. I think it was specifically not just for cash, but for a mortgage. Josh seems to think that allowing people to use their stock as collateral for mortgages is a recipe for gosh darned apocalypse, because it's going to make people too big for their britches, take too much money too fast. Next thing you know, Amazon's going to take it in the beak. Next thing you know, you're not going to have a house, and the kids are going to be pulled out of school and all the things. How do you manage the risk? Is there risk? And what is your point of view on the use of unvested but awarded stock? In this case, Amazon equity, but I suppose it could be any publicly traded company, or for that matter, a private company, I suppose, as collateral for borrowing.
So I feel very strongly on this particular topic, and I could not. Well, first of all, I didn't. Before I say what I could not. I could say I could not disagree more. I could not agree more. I could say either one. But I didn't get it's not like Dylan Ratigan to throw it off onto a third party. I didn't get
I'm not throwing anything off.
It sounded like you were a little you didn't want to give your take. The whole truth or skepticism.
I have a take.
Okay. You just want mine first. I'll give you mine first. As long as you have a take, I'll give you mine first.
I got takes for miles.
Okay.
I know my take.
All right. I'll give you mine.
I just was trying to elevate Josh's celebrity here on Truth or Skepticism in the hopes that he too might get a raise. Like, it's sort of like the more Josh is mentioned on Truth or Skepticism.
Raises for him are highly unlikely.
The more Josh is mentioned in public, the more money he might make. Like, it's sort of like his version.
That's not like it's not like a JP Morgan thing. Well, anyway, my take on this is I could not disagree more. In fact, I think
what? You couldn't disagree with any. You're saying concerns about the use of this stock as collateral are misplaced.
Concerns with use of stock as collateral are misplaced, and not only that, it's just outright. It's I hate to say this, but it's outright dumb.
I feel like you're about to be insulting. Yeah,
I am a little bit insulting this.
Yeah.
The idea that we should not be able to use like our earned assets, our earned equity, especially
collateral,
especially in the case of restricted stock, like I'm pretty sure they're talking about at Amazon. But just think about it this way: if Dylan Ratigan or anybody else that you know wants to buy or wants to buy stock through Tasty, okay, whatever you want to buy, we'll lend you 50%.
Without a credit check.
Nothing.
Well, no, I need a minimum balance.
To whatever. We'll lend you up to 50% of what you want to pay. So if you want to buy $100,000 worth of stock, we'll give you 50.
Yeah.
Okay, whatever you want to do. We don't ask what stock you're buying. We don't ask whatever. We'll give you. And you're telling me that if I want to use, if I have $100,000 worth of Amazon restricted stock, and I want to use $20,000 of that for a down payment for a house, that's a recipe for disaster? That's the most ridiculous thing I've ever heard. Because right now you can take that Amazon stock, go to any brokerage firm in the world, and borrow 50% on it. It's absolutely it's misplaced. It's almost uninformed to a certain extent, and you should be able to use that collateral anywhere you want to use it, especially if it's restricted. Okay, 20, 25, 30%, 50%, whatever it is. But we right now will give you that. This brokerage firm will give you whatever you want up to 50% to do whatever you want. Take it out. Do whatever you want with it. I don't care.
Okay. Again, you're being a little bit hyperbolic, I do believe, but at the same time.
Hyperbolic? No, I'm not being hyperbolic. I'm just putting it.
So you're going to give me $50,000 to go buy hookers and cocaine?
I'm not going to give you, but if you put up, if you have $100 worth of stock with me, you have $100,000 worth of stock with us, and you want $50,000 for hookers and cocaine, sure, we'll give it to you. Mm-hmm. No problem. Because I don't know what you're going to do.
And you'll take any publicly traded equity.
Sure.
So it doesn't even have to be some sort of Amazon, Apple, whatever. It could be.
It has to be It has to be marginable by. It has to meet the margin. It has to meet the marginal.
What is that? 5,000 stock? How many was that? 1,000 names? 5,000 names?
Oh, it's like 4,000 names. It's like almost everything.
Thousands of companies.
I think it has to be. I think it means the stock has to be over $3.
Yeah. Okay. But the point is, it's many, many names. It doesn't just have to be.
I don't care what stock it is. Basically, any stock you want, you give us 100,000, we'll give you 50. We don't even ask you if you're going to spend on hookers and blow. We don't care what you're going to do with it. Do whatever you want.
All right. Okay. So the deal is any stock, 50%. Enjoy yourself.
Have a party.
Enjoy.
That's right.
Go nuts. Okay. So clearly, the use of stock as collateral is valid. Let's just start like this. I'm not going to get into a dispute. It's idiotic.
Of course, it's your money. Sure.
It's fine. So the only actual question is, who draws the lines where? In other words, not all stocks are created equal. Amazon is not the same as Joe's Fish Shack.
That's correct. And so
I got a couple of questions. Oh, you'll get your chance. But which stocks are eligible? One, does it creep into private equity? If you own stock in XYZ Corporation, that's a very different.
First of all, private equity.
Okay, you'll get your chance. But again, there's private companies that are very, have a lot of integrity, shall we say? SC Johnson, by the way, family company, family owned. It's a private company. They can probably take loans against that equity from a bank, I bet.
I'm sure they can.
Yeah. So you have sort of I'm interested in the gradient, what stock qualifies for as collateral. And at what? And then who determines the percent? Is it at 50%, like you're talking? Is it at 80%? Is it at 20%? So I'm more interested not in whether stock can be used as collateral. Obviously, stock is collateral. Like it already is collateral. That's your whole point. So it's self-evident. Like it's not a discussion. Stock is collateral.
Right.
Okay. It's an asset. It's collateral.
Right.
The only question is which stock qualifies as collateral and at what discount does it get funded?
Sure.
And who does? And the most important thing for those two questions is who decides.
That's right.
Who decides? So I'm asking you.
Oh well, if it's a listed,
qualifies, what's the rate and who decides?
Okay, so if it's a listed stock, it's pretty simple because
of course,
that's pretty cut. That's pretty black and white.
That's already been markets have already been made for years of that at 50%.
That's right. Whatever. Yeah, and there's some stocks that are a little higher. Great. You know, we have certain stocks that we will not lend out 50% on. We might lend out, 20% or 10% based on the amount of float or liquidity or, whatever size.
Is that at the discretion of the brokerage? Is that a tasty decision, or is that an SEC decision?
It's a tasty risk decision or clearing firm decision, based on availability. But that's usually.
I might get a better deal at a different broker theoretically.
It's pretty rare. I mean, you're talking about. In the whole world universe of like 4,000 stocks, you're probably talking about less than 20. So it's not
at the final edge of decay.
Yeah, it's an insignificant. That's not really a topic of discussion. But if you're talking about like, let's get back to the Amazon discussion first. The Amazon discussion has to do with restricted stock in Amazon. Not if it's your stock, you can already borrow 50% against it. So we're assuming it's restricted stock. And in the restricted stock world, it's a little bit different because of liquidity concerns, things like that. But if you wanted to do 20 or 25%, I'd have no issue whatsoever.
What about 50?
No, I think 50.
Well,
50% of restricted stock's hard because you have a different threshold for that, and you might not necessarily be able to liquidate it in the case of a call. So that's why that has to be lower. Now,
also in the Amazon case, and I'm sorry to interrupt you, but it's also double collateralized because behind the stock is also the house. Like it's not just a loan. It's not a hookers and blow loan.
Yeah. Sure.
It's a home loan.
Sure. And there's an asset behind it, of course.
Right. So I got two assets. I have the stock and I can take the house.
Yeah, exactly. And then lastly, you talked about private companies. That's a little bit more complex because those are very difficult to get a true valuation on because like Amazon restricted stock has a real valuation. I mean, it is what it is. But a private company that's not public yet, you've seen private companies move all over the place in the last couple of years. They could be $50 billion. Next thing you know, they could be 10. Private companies, I think, you should be able to, and now again, this is if somebody is willing to lend you money on that. But I think you're really talking about, it'd probably be somewhere in the neighborhood of 10% on a very speculative private company, a small cap private to.
I've got $1 million worth of XYZ startup. You give me $100,000.
Maybe. Yes. It's like a pawn shop. I mean, listen, you think about it like a pawn shop. If you walk in with $100,000 something to a pawn shop, $100,000 watch.
Diamond ring,
$100,000. You know what they're going to give you at the pawn shop?
$10,000.
$10,000. If you're lucky.
Not that I've done that, but yes.
$10,000. Okay. Yeah. So it's the same thing. Now, if it's a bigger, like let's say it was like Instacart or Square, the
Series C, Series D, it's been vetted 50 times, blah, blah.
Maybe 20, 25%, I don't know. I probably, as a risk taker, if you came to me right now with what I felt was a reasonable valuation in Square, because it's already been marked down, I would lend you money at, let's say, 10%. Using Square on a 25% collateral basis, I do that in a heartbeat. So yeah, sure, I do it.
So it brings up a bigger question. The Amazon thing is sort of the leading edge of the question, which is there a financial services marketplace to make markets in lending against restricted stock in publicly traded companies or private companies?
Oh my God. Actually, there already is one. I mean,
and that's what my question. I don't know.
Yeah,
how
there already is
that
one.
market?
Yeah, there already is one. But yes, there'd be a huge
And
market.
who's making that market? All the banks, basically.
Banks and financial service companies, private financial service companies. There's a huge business in that. Like you can right now. I mean, there's a secondary market for non-public companies. They trade at a discount to projected IPO price, anywhere of 33%, 40%, depends on how hot the market is. Yeah, right. It could be all over the place, but people trying to raise cash for various reasons, of course. I've been shown.
What about options? What if I own options? What if I own Amazon options, not restricted stock?
Well, options
and are deep in the money.
Okay, so I would have no issue with the same situation with options, because all options is all you have to do is figure out a volatility, and then you can basically back into an option valuation. But if you wanted, there's not really a big loan business for stock options, but if you had a fully vested stock option and you wanted to borrow against it, and you were, let's say, $10 in the money, that's not very hard to figure out, where we would lend money at.
How to make markets on that you can create a price.
Oh, well, you're just creating a theoretical price, and then you're lending money on, maybe 10, 15, 20% of that. We would do that all day at 9, 10, 11% till our hands bled. I mean, we would take, every dime in capital at this firm and lend that money out at 10% if we could.
From the customer side.
Yeah.
So I get it from the institution side. The math is there. People can do math. They believe in the math. The math historically holds up. You can make markets. Fine. From the customer side, is there, because the customer typically is not as sophisticated as the creditor, because they're not making loans all day, every day. They're taking a loan once in a lifetime, sure, or twice in a lifetime. Is there a risk of the borrower making doofus decisions that, in other words, are you setting up a risk of financial catastrophe for the borrower?
So now you're asking if there is.
I'm inviting catastrophe by allowing liquidity against these assets.
I find that, you're asking me if.
Now you're saying it's a nanny state question.
Exactly.
You're about to say, what am I, your mother?
Yeah, I was about to say, what do you want me to play God and tell you if it's going to be a good investment for sure? So all of a sudden we're supposed to, our role is to facilitate opportunity, not to give you our opinion of your. That's like, do you really want me to ask my lawyer and my accountant for the opinion of every trade I'm about to make? Of course not. Do I want to ask my compliance officer for every time?
But it brings us back to a regulatory conversation from a few weeks ago, which is the regulators sit in a position of thinking that they're protecting the consumer, sometimes from the financial institutions.
Which is why I hate regulators.
And sometimes from themselves.
I understand. But I mean, it gets to be, it's your money, Dylan Radigan. You do whatever the hell you want. It's our job to facilitate your ability to do that. That's what makes it great. That's what a free market really is. That's what the whole frontier that we're trying, the whole ecosystem we're trying to build. That's what it is. Facilitation of opportunity, not sitting here judging. How do I know if it's a good trade? I mean, if we sat back and we looked at everything in the past and we looked at all the trades that we've missed, why didn't you buy Bitcoin at 14 cents a coin?
Sure.
Because some idiot said.
Your point is to have any opinion on use of funds is preposterous. The only opinion you can have is on the collateral and its accessibility.
Of course, because again, I'll go back to the same argument, which everybody, if you asked 2,000 professionals, whether or not you should have bought Bitcoin at 14 cents or 25 cents, they would have said to you, "You're out of your freaking mind. Why would you waste a dime?" I sat here and had a chance, interviewing the founder of Ethereum when it was less than 25 cents a coin. And Tony and I laughed at him. Like, who would buy this kid from this kid's basement? Okay, well, it went to $4,000. It's still $1,600. My point is, but every financial advisor in the world would have told you to do the opposite. So, I mean, all of a sudden now we're gonna, we can't. You can never be validated, because if it's what everybody else is thinking, then it's going to be wrong. So we have to do our own thing. That's the key.
On the flip side, as we allow things like borrowing on restricted stock or stock of any kind in this context, is it a pathway to more engagement by virtue of people then understanding the value of reducing cost basis by selling?
Of course. It's a no-brainer, 100%, of course.
Can you sell options on restricted stock?
No, you cannot.
So you'd have to post cash in an account and do it synthetically, basically.
It's almost
as a theoretical.
As a theoretical, and it's almost impossible, because you potentially could lose. If the worst case is the stock goes to the moon, and you're trapped in two different accounts and you can't meet the margin calls. So the answer is, it's been tried. There's been a few.
You're saying when people try to fund a cash account to sell premium against a restricted account, and they just get wrapped around a tree.
Exactly. You could get wrapped around a tree. You get blown out. It's ridiculous, which is why none of us hedge any restricted stock ever, because it's a death trade.
So therefore, it does not actually provide an incentive to reduce basis, because you can't reduce basis in a restricted stock, or for that matter, an option.
You currently cannot. There have been many proposals and various exchange plans put in place that would allow for a OTC market to allow you to write, against restricted stock. But it just hasn't gained any traction over the last couple of decades.
Which would work how? Where if I wrote an option against restricted stock and you were on the other side and it blows up in my face, then that restricted stock gets assigned to you at some future date?
I think it gets settled. I think it's cash settled or something like that. I'm not really sure. I don't remember all the details, but it's doable. It's funky. It's clunky.
But let's go back to the beginning of your answer to my question, which is, I said, do you think that allowing people to borrow against restricted stock increases engagement? And you said absolutely.
Yeah, absolutely.
How? Where?
Well, I think it just, I think it's good for how could it be bad? No,
I'm not saying it's good or bad. I'm saying, where's the engagement? If I can't sell options against it, I can't.
No, but you could. I don't care if you can sell options against it, but to borrow against it allows you to potentially invest in other things, which is good for the economy and good for you potentially. That's it.
Then it creates more liquidity.
It creates more optionality, more liquidity.
More participation.
Yeah, all over the place and everything. I mean, listen, that's how, how do you think the Elon Musks of the world became the Elon Musk of the world? Basically, he leveraged his PayPal to the max to build Tesla, right? Something like that.
For sure.
Leveraged Tesla to the max to build SpaceX. I mean, it's just that's
and he just leveraged it all to the max to buy Twitter.
Okay, there you go. So why can't you do that? Why should you not be it? Why should everybody else be able to do that? Why should Elon Musk be able to do that and Dylan Ratigan can't do that?
Sure.
Like, we sit there and we applaud the guy and go, he's a freaking genius. And then out of one side of our mouth, the other side of our mouth, we say, hey, you know what? I don't want you to be able to do that. Well, that's ridiculous just because this is our public,
All right. You see the Americans and the Germans trying to backpedal on their support of Ukraine?
No, I don't know what you're talking about.
Yeah. You should get it. We should look.
Yeah. No, I don't want to get into a political discussion on Ukraine, but no, I don't.
I'm telling you. You heard it here. Mark the date, March 8th. Today's the first day since February 24th of whatever last year was, 22. Exactly. That you just wipe your face and just shake it off like a dog shaking off a bad thought.
Do dogs have bad thoughts?
No. Definitely not.
I don't think so.
That's why they're dogs. That's why people like them. They don't have bad thoughts.
That's right. That is why.
That's the difference between dogs and people.
That's right.
No past, no future, and no bad thoughts. Dogs are just positive present tense beings.
That's right. That's why we don't deserve dogs, because we're not worthy of dogs.
Because we're laden with future and past thoughts and bad thoughts.
That's right. You're exactly right. And again, that is exactly why we don't deserve dogs.
I've been trading those Amazon options, by the way, ever since I spent the day with your friend Tony from Mexico.
Nice. Good.
Yeah. It's pretty good. It's pretty good. Amazon's actually, I've never traded Amazon before any which way. But
Amazon.
Very liquid, very friendly, very...
Amazon, Apple, Tesla, those are probably the three most liquid underlyings until you get to the stock indices, but they all trade like...
they trade like an index. Easy in, easy out.
Yeah, they trade like water.
Quite pleasant. It's nice to trade things where the only thing you have to worry about is if the trade, as opposed to the mechanics of entry and exit.
That's right. It is. Anyway, we can wrap up here because that was a good discussion.
You're done? That's it?
I'm spent.
Oh, it's International Women's Day. Did you wish your wife a happy International Women's Day?
No, she doesn't know about International Women's Day. She's old school. She's a Valentine's Day girl. But you, my friend, I know something about Eastern European women, and if you don't wish your wife a happy International Women's Day, you're a dead man. She's gonna cut your pee-pee off. I'm just gonna tell you that right now. So you better get on. You better do something special.
Noted, sir.
Okay, just don't. Yeah, I put the warning out there just so you know.
I've taken my notes.
I'm Tom Sosnoff. He's Dylan Radigan, or at least he was. He might not be next week. We'll see. Have a great week, and we'll see you next Wednesday, Dylan.
All right, enjoy.
Thanks.